Wahid Chammas is portfolio manager for Janus Capital. Janus Capital is an American global asset manager. Today we have the pleasure to discuss with us the opportunities of the European market. Welcome.
Thank you for having me.
Thank you. So my first question is, can you explain us why you are still so positive on the European stock market?
Yeah, I think a lot of investors have missed out on the great opportunities we've had in Europe for a long time. And I think they've been waiting for the wrong cues. They've been waiting for the economy to improve or things to get a little bit more stable politically. And yet, time and time again, people misunderstand what Europe is. The European companies have very little actually to do with the European economy. Today, less than 46% of revenues even come from Europe in the MSCI Europe Index. Now, our fund has even less exposure to the European economy, even though it's almost 100% predominantly European companies. And this is not a phenomenon that's been going on short term. This is, many centuries and decades in the making, where companies are able to create value no matter what theme you're playing. A lot of folks think it's just about consumer stocks selling products globally, but it's not. It's about pumps that do the frac pumps for shale gas. It's the companies that do the seamless steel pipings for oil and gas. It's your iPhone, the chemical company that keeps your iPhone together and all the different components. So no matter what sector you're dealing with, a lot of European companies are very central in the food chain. And so we truly believe that taking a step back and thinking about companies first and how one creates value in a sector as opposed to an economy enables you to see Europe in a very, very different light.
Okay, but regarding valuation, because the European market have been done so well this past few months,
Sure.
Are you still positive?
Actually, valuation is actually one of our great stories, because as much as European stocks have done well, the disparity in terms of valuations relative to any other global index has actually never been as wide. Today, going back 20 years, but even if you go back to the 1960s, the valuation disparity between Europe and the MSCI Global or even the US is close to about 30%, 25 to 30%, but that's only half the story. What's also interesting is you're starting off at trough margins and trough ROEs, whereas in many other regions, like in the US, we actually have very strong productivity and very strong margins. So if you're playing a reversion to the mean phenomenon, and you're saying, okay, well, here I have an index which is 30% cheaper or 25% cheaper, and yet the margins, the starting point in terms of low-hanging fruit is so much lower. It's not always great to talk about austerity, but the world of austerity that we live in Europe has actually enabled companies for the first time to boost productivity and boost margins. And so your starting point from a valuation is low, and your starting point from an earnings productivity and return on equity is also quite low. And so we actually think Europe is one of the areas where it's going to be easier to make money going forward.
Okay, and finally, there is also some other indicators that are improving in Europe. Can you explain us?
Sure. Whereas the last 5 years one had to be quite defensive and talk about companies growing earnings and creating value globally, and the valuation discussion, a lot of folks are getting a little bit more excited on Europe. And I think they're getting excited because things are getting better on the margin in Europe, whether it's leading indicators, PMIs, retail sales. A lot of companies have deleveraged quite aggressively. But I do caution investors that I'm getting a lot of interest on our European equity fund, for instance, even from investors as far wide as Asia, because I think they're seeing this pickup in economic leading indicators. But I would just say, if things do decelerate next year from a political standpoint or an economic standpoint, it doesn't really take away from the very wonderful structural drivers that Europe offers in terms of, again, the stocks, not just the economy. And so, yes, things are getting better, but that is not the only reason one should be positive on Europe. There's actually a structural story behind it all.
Okay, and one more question. How do you manage this environment in Europe?
Yeah, it's actually a great question, because there's a lot of ways you could invest in Europe. Now, we do things a little bit differently at Janus. We are, first of all, structured in 7 global sectors, and our analysts are truly global in their outlook. So it's not just enough to talk about how global the companies are, you need to be structured, in our view, the right way. And so the analyst that thinks about tablets and iPhones is helping me in Europe looking at companies like ARM Holdings and ASML that make the tablet what it is today. And so when you have this kind of structure, you're able to actually construct a portfolio that doesn't take any sector bets. So we are one of the only largely sector-neutral European strategies. And everything we think about in terms of stock selection is really at the sectoral level. And then I bring all the sectors together, and you have a best ideas, truly stock-picking portfolio with a lot of risk management around getting rid of anything else. So anything related to country bias or market capitalization bias, or even, of course, sector bias, as I mentioned. When you do it this way, then you can actually deliver a product which has done well, but I can actually also offer the fact that it is truly giving you the best that Europe has to offer from a global perspective, and not playing any cyclicality or not having any macro bet, and really gives you a good, consistent experience.